option strategies. What are the types of strategies are there in the market? One is directional, another one is non-directional. When I say the name directional, you would have already understood what kind of strategies will be there, but still I would like to say about that. Directional means you know the way that the market is going to go. It is going to go either upside or downside. Based on that, you create your strategy and you deploy the strategy. In non-directional, you don't know where the market is going to go. It might go either go up or down, or it might not go either the side. It might be consolidating in a small range as well. So that is called as a non-directional strategy. When it is coming to directional, it is either uptrend and downtrend. When it is coming to non-directional, as I have mentioned, it might be going one side, right? It might go up or down, and another one is sideways, which is a neutral trend. Speaking about uptrend, there is a small chart which you can see right now. This is called an uptrend market, and the second chart indicates downtrend market, and the third chart indicates that the market is in a small range. It is in consolidating. Okay, and the one side move, that is the market is in small range. It might go either upside or it might go either downside. So one by one we will see what is there in uptrend, downtrend and neutral trend and one side move. In uptrend, you can have a call buying strategy, you can have a short put strategy, bear call spread, bull call spread and bull put spread. Now coming to the downtrend, you can buy the put, you can short the call, bear put spread, bear call spread. Now coming to the neutral trend, that is one of the strong part of this course. All this neutral trend strategy, we are gonna backtest each and everything one by one, and we are gonna see what is the results of these strategies are. Okay, the first strategy is short strangle strategy, short straddle strategy, short iron condor, short iron fly. So these are the four strategies are there in neutral trend market. Now next, one side move. One side move means the market can go either go up or down, right? You buy the call and you buy the put as well. That is called long strangle. In the same case also, in long straddle, you buy and call, you buy the put as well, but the strike choosing is different in this one side move, long strangle and long straddle. About that also we'll be seeing brief in the further classes. So let's get into the next topic. Speaking about the directional trading, in order to trade into the directional market, you should have a technical analysis knowledge. It might be a chart pattern, it might be a candlesticks, it might be anything which is related to technical analysis. Then only you can be a directional trader. Speaking about the directional, the uptrend market is there and downtrend market is there. In uptrend market, these are the types of chart patterns you can look for in order to trade. One is ascending triangle, bullish wedge, bullish flag, bullish triangle. So these all four types of chart patterns comes when there is a bullish continuation of the market. When the bullish trend is already there in the market, you can find these four chart patterns. And when it is coming to bullish reversal, okay, bullish reversal means, it means when the market might be in the bottom side, we call it as a support. In that bottom, you can look for double bottom and triple bottom, inverted head and shoulder and falling wedge. So these are the four kinds of chart patterns you can look for bullish reversal. The same opposite is in downtrend. For bearish continuation, already the market is in bearish, you can look for ascending triangle, you can look for bearish wedge, you can look for bearish flag, you can look for bearish triangle. In bearish reversal, we have double top, triple top, head and shoulder, rising wedge. So these are the one of the good chart patterns you can look for in order to trade in directional trading. And we also have many other chart patterns, peanut pattern, many patterns. We don't want to see each and every pattern. So the most used pattern by the traders are this, and these are some powerful chart patterns. Now let's look at some candlesticks patterns as well in order to trade in directional trading. In uptrend market, as in for the candlesticks pattern, you can look for bullish murubuzu, hammer, inverted hammer, bullish engulfing, bullish harami, morning star. In downtrend, it is same opposite, bearish Murubuzu, shooting star, hanging man, bearish engulfing, bearish harami, evening doji star. There are many more candlesticks patterns are available in the market, but these are the most strong candlesticks which you can use in order trade in directional market. But when do we use this candlesticks pattern in the uptrend? When there might be a resistance breakout, you can look for these candlesticks in uptrend, and when it is downtrend, you can look for support breakout, or you can call it as a breakdown as well. In that time, you can use this candlesticks pattern for your confirmation of your directional trading. And these were the chart patterns and the candlesticks patterns I have mentioned you. We have also something called like an indicator, which many might know that. So one of the most common indicators and powerful indicators many traders use are moving average, super trend indicator, moving average crossover, parabolic SAR, CPR indicator. So you can use these 5 indicators based on the confirmations as well in order to do for directional trading. The next topic which we are going to see is delta decay and time decay. So we haven't price, we haven't time. So let me assume the Nifty is at 17,500 and you are going to buy an ATM call option premium which is 250, and the market has went down to 17,400. At that time, what will be your at the money premium value which you bought at 17,500? It will be 200. So decrease is how much? It is 50 points has been decreased when the market has fallen 100 points. Now understand one thing, the ATM call option which you bought at 17,500, when the market has fallen to 100 points, now it has become OTM call option, right? We have no doubt in that. Now once again what happened, the market has moved towards the upside. It has closed at 17,500, but the premium value has increased only by 30 points. So the overall value of the premium is 230. When you bought at the market was 17,500, the premium value was 250. Now when the market once again came to 17,500, now the premium value is 230 only. So there is a decrease of 20 points. It is the reason behind it is as, so when the market came down, it was an out of the money. When the market moves from out of the money to ATM money, it will move lesser, right? You know that concept. Delta is higher at ATM, delta is lower at OTM, delta is high, very much higher in ITM. Okay, if you want, you can note it down. Delta is higher in ITM, delta is moderate in ATM, delta is lower in OTM, which also means, I will explain you once again, when the market is decreasing from ATM to OTM, it will decrease in moderate level. When the market is now increasing from OTM to ATM, it will increase in only lower, in a very lesser way. Understood? So this concept you can note it down in your notes as well. So now coming to the time decay part. When it is coming to time decay, we have from 9:50 to 9:30 p.m. in the market, right? We have no doubt in that. The market has opened 9:15 and the market has went till 17,500. At that time the premium was 150, but when the market once again closed at 17,500 during 3:30 p.m., the premium value is now only 130. This is called time decay, which means the market has passed one day. So when the market is coming to the expiry, it has options has an expiry, right? For example, weekly expiry, we have 5 trading days. So the one day has been passed now, due to which the premium value will be decreased. And in order to explain you more deeply, let's understand that as well. The market was 17,500. Now the market came down by 25 points. Now the premium value has decreased by 10 points. When the market went above 17,485, now the premium value is 143. And when the market came once again towards the downside, 17,450, now the premium value was 125. But when the market has increased by 50 points from here to here, still the premium value has increased only by 5 points. This you will notice in the real time in the market as well. Might be you would have been trading the option buying, then you can easily notice these concepts. This is the concept like time decay and delta decay, both of them are happening, because when you bought ATM at 1450, it would have, when the market went to 17,450, it would have been now OTM. Now once again the market went towards the 1750, that time only it became once again ATM. The time has also been passed, the decay has also been happened in delta, in time, both the way it has happened, right? Due to which an option buyer has a higher probability of losing the money when it is happening delta and time decay. Some might have a doubt, does future trading happens with time decay and delta decay? No. When it is coming to future market, I am giving a small example. Towards the downside there is a graph where you can see the nifty value is 17,500. This is the future chart. Let's me assume I bought an future buying, I mean long, I have gone long on future at 17,500. Now the market came down to 17,300. What does that mean? I got 200 points as a loss. Now the market went to 17,500 once again. Am I losing anything with time decay and delta decay? No, there is no time decay and delta decay in future market. If at all, what is the price in the change of from where I bought into the quantity is my profit or loss. If at all the price is in positive from where I bought, then it is my profit. If at all the price is in negative, then I will be in loss in the future. So it is a simple concept in future. In options only we have the first strategy in this course we are going to say is short straddle, and I'm going to give you the example with the Nifty, and we are going to also trade this strategy in Nifty only. Why not Bank Nifty? About that we will see later. And before getting into the strategy, entry plan, exit plan, target and stop loss, we will first understand the nature of straddle, how it works, how many traders use this strategy. Then we will go into the backtesting data and we will understand all the conditions of our entry, exit, each and everything. Okay, let's start. Now let us assume this is a small chart which you are able to see. You can see the candlesticks, right? Let's assume this is a Nifty 50 chart and the Nifty's price is at 17,300. When the Nifty is at